it's me, Yusmita Zakina. I'm from Mercu, Buana University. Okay, to fulfill a big test in English for accounting, on this occasion, I would like to present about balance sheet, financial statement, direct and indirect cost. Okay, the first one, balance sheet. The balance sheet report as of a given point in the time research of a business, asset, its obligation, liabilities, and the residual ownership claim again in the research, owner's equity. By analyzing the relationship among these items, investor, creditors, and other can ability to pay all current and long-term debt as they come due. The balance sheet also shows the composition of assets and liabilities, the relative proportion of debt and equity financing, and how much of a firm's earnings have been retained in the business. Concept of balance sheet. There is two concepts is particular of all assets and liabilities of the concerned institution on the debt which is prepared. Sometimes two balance sheets may have to be prepared. First one, balance sheet in the beginning of the accounting year to ascertain the amount of capital fund in the beginning of the accounting year, and two, balance sheet at the end of the accounting year to show the financial position of the institution as on that date. Okay, and then elements of balance sheet. There is three elements of balance sheet: is asset, liability, and owner's equity. Asset. There is current asset and non-current asset. Current asset are items of value that are expected to be consumed or converted into cash within the next 12 months. Example include cash, inventory that is turning over regularly, and account receivable. And then non-current assets are not expected to be consumed or converted into cash within the next 12 months. Liability. There is current liability and non-current liability are not expected to be paid within the next 12 months and include creditors, account payable, inventory purchase, overdraft, short-term loans, and credit card debts. And then non-current liabilities are not expected to be settled within the next 12 months and include mortgage and building and equipment and long-term loans. And then owner's equity. Owner's equity is the residual interest in the asset of a business after liabilities are deducted. It is the net worth of a business and equals the difference between asset and liability. Okay, and then form of balance sheet. The form of the balance sheet presentation vary in practice. Its form might be influenced by the nature and size of the business, by the character of the business properties, by recruitment set, by regulatory body, or by display preference in presenting key relationship. The balance sheet is prepared in one of two basic forms. There is the accounting form with asset-based report on left-hand side and liabilities and owner's equity on the right-hand side. And then the report form with asset, liabilities, and owner's equity section appearing in vertical arrangement. Okay, and further discussion of financial statement. Financial statements are written records that convey the business activity and the financial performance of a company. Financial statements are often audited by government agencies, accountants, firms, and etc. to ensure accuracy and for tax, financing, or investing purposes. Companies prepare for financial statements from the summarized accounting data is income statement, retained earnings statement, statement of financial position, and statement of cash flow. The first, income statement. The income statement is one of a company's core financial statements that show the profit and loss over a period of time. The profit or loss is determined by taking all revenues and subtracting all expense from both operating and non-operating activities. You can say this for the example is Softbite Incorporation, where this net income is 2,715. Report the revenue and expense for a static period of time. Net income is revenue exceed expense. Net loss, expense exceed revenue. Okay, the second one is a retained earnings statement. Retained earnings are the portion of a business profit that are not distributed as dividends to shareholders, but instead are reserved for reinvestment back into the business. Normally, these funds are used for working capital and fixed asset purchase, capital expenditure, or allotted for paying off debt obligation. You can say this example of SoftBite Incorporation. The retained earnings September is 1,450. Statement indicates that the reason why retained earnings has increased or decreased during the period. Statement of financial position. The statement of financial position, often called the balance sheet, is a financial statement that reports the assets, liabilities, and equity of a company on a given date. In other words, it lists the resources, obligations, and ownership detail of a company on a specific date. You can see a statement of financial position of SoftBite Incorporation. In the statement of financial position, total assets and total equity and liabilities must be the same. Okay, the last one is statement of cash flow. A cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operation and external investment source. It also includes all cash outflow that pay for business activity and investment during a given period. Okay, the last discussion is about direct and indirect costs. Direct and indirect costs are accounting concepts that help you separate expenditure that fluctuate relative to how much business transact and costs that stay mostly the same, whether you sell one item or 1,000. Direct costs are considered direct because the expense incurred go directly into the products to service yourself. Indirect costs are indirect because they discrete items necessary for running your business but not necessary for producing your products. The most obvious example of the direct costs are the materials that go into producing the items you sell and the labor that goes into creating it. Rent, utilities, and payroll are examples of indirect costs. Okay, direct costs. Direct costs are easily identified and assessment to CACFP. Direct costs are costs incurred specially for a program or other cost objective and can be readily identified to a particular objective, such as food service. Example of direct costs is the most obvious example of direct costs are the materials that go into produce the item you sell and the labor that goes into creating it. If you manufacture clothing, the amount of fabric and thread you use will vary directly in proportion to how many shirts you make. Even if you retail item that another business manufactures, the amount of inventory you purchase will vary relative to how many items you sell. Similarly, you'll pay your employee for a greater number of hours if they make 200 shirts from if they make 20. And then indirect costs. Indirect costs can be easily identified or assigned to the CACFP. Indirect costs are costs typically incurred for the benefit of multiple programs, functions, or other cost objectives, and therefore cannot be readily or specifically identified with a particular program or other cost objective. For example, the rent you pay on your facility is an indirect cost because it doesn't fluctuate to your sales volume. The utilities costs you incur to keep your operation going are considered indirect costs as well, because you have to keep your light on and your rooms heated whether your business is thriving or struggling. Payroll for office staff that keeps track of payroll is indirect cost as well, because it goes into general operation rather than specific item that you sell to generate revenue. Okay guys, thanks for the time, and I hope what I discussed earlier can provide a little understanding about what is a balance sheet, financial statement, direct and indirect costs. Thank you.